At their next meeting, should the Federal Reserve cut interest rates? There's a case to be made to cut rates. There's also a case to be made not to cut rates. Currently, Fed funds futures give us 98% probability the Federal Reserve will cut interest rates by a quarter point to the 450, 475 region. In December, there's a 69% chance of another quarter point cut to the 425, 450 region. Interestingly enough, in January, there's a 90% chance the Fed will not cut rates. They will remain at 425. And then there's a 70% chance we'll see 4% interest rates by March. So why should the Federal Reserve cut interest rates? Let's compare the economies of 2007 to present date. Fed interest rates in 2007, September in particular, were at 525. By October, they were 475. That was a half a point cut. Another quarter point cut in November to 450. So, what was the state of manufacturing like in 2007? Well, you can see the Empire State Manufacturing Index in 2007 wasn't great, wasn't awful either. 14.7 in September, 25.7 in October, 25.9 in November. Remember, this is when the Fed first started cutting interest rates. What does manufacturing look like today? Well, not so good. We can see the Empire State Manufacturing Index has spent the better part of the past year in negative territory, currently negative 11.9. In fact, we've seen negative readings 10 out of the last 11 months. How about the jobs market in '07? Well, non-farm payrolls we see in September of '07 registered 86,000 jobs created, 72,000 and 116 in October and November of the same year. How about the jobs market today? Non-farm payrolls, the latest report, very bad. 12,000 jobs created following last month's 223. So why should the Fed not cut interest rates? Well, lower interest rates plus the current perception of a stable economy equals surging bond yields and stocks. You've probably noticed bond yields have been on the rise. In particular, the 10-year US Treasury has moved from the 360 level about a month ago to almost 440 at current date. That started with the last Fed meeting. You see, the Federal Reserve cut interest rates, but with the perception of a stable economy, that led to the perception of a stronger economy in the future with lower rates, and that led to our surge. However, the problem is, as bond yields surge, so do eventually we will expect mortgage rates, car loans, credit card bills, etc. So as Treasury yields move higher, this is going to weigh on the economy, and there's going to be a point when this becomes too high for us to bear. Vote in our poll. Should the Federal Reserve cut interest rates? Yes, by a quarter point, by half a point, or no, they shouldn't cut rates at all. We thank you for joining us. We look forward to seeing you back soon.